If you own a home and you have equity, you're sitting on the most powerful financial tool available today. But most homeowners don't even know how to use it. And choosing the wrong tool can cost you thousands, or even force you to start over financially. Before we dive in, hit subscribe, smash the like button, and tap the bell icon so you never miss our future money-saving guides. And if you want to talk to me directly, I'm offering a free 15-minute consultation. Click the link below, and we'll chart your best move together. And let me be transparent with you. Everything I'm teaching isn't just theory, it's real life. Back in 2008, I owned a home valued at around $650,000. When the recession hit, that same home dropped to about $200,000. Almost overnight, I lost nearly $500,000 in equity. It took me 10 long years just to recover some of what I had lost. I let the economy dictate my fate. Never again. And I don't want that to happen to you either. This is why I break everything down the way I do, so you can make empowered decisions before the market moves, not after. Today, we will deep dive into what a HELOC really is and the different types, including draw period and repayment period, how to use a HELOC for investment, what a HEI, home equity investment, is, how it works when it's smart, what a home safe is, and how retirees use it for freedom and legacy, real-life scenarios featuring our friends, Harmony and Chris, Donna and Ron, Nikki and Steve, and at the end, a legitimate forecast from top firms about the housing market, so you know the context you're operating in. Everything here is for educational purposes only. Always consult a licensed mortgage professional. NMLS 1020597. HELOCs, home equity line of credit, your equity on demand. What is a HELOC? A HELOC is a revolving line of credit secured by your home's equity. You can borrow up to an approved amount, repay, borrow again. Think of it like a credit card. But the interest is normally much lower because the loan is secured by real estate. Key components to understand draw. Period. The time during which you can borrow, and you typically make interest-only payments, often 10 years. Repayment period. After the draw ends, you must pay principal plus interest over a set term, often 15 to 20 years. Without proper planning, your payment can jump significantly when the draw period ends. Traditional variable rate HELOC rate floats, prime plus margin, draw for 10 years, interest only, then repayment phase for maybe 15 years. Risk. Rate increases, plus payment shock at end of draw. Fixed rate HELOC, hybrid or fully fixed. You might lock in all or part of your HELOC at a fixed rate, 5, 10, 15 years. Gives you payment stability. Less common. Banks don't always advertise it prominently. HELOC versus cash out refinance trap. Many homeowners think, I'll just cash out refinance my mortgage and get the equity. But that often, higher cost, new 30-year loan, paying closing costs, losing your low mortgage rate. In many cases, a HELOC is more cost-effective, flexible, faster to set up. How to use a HELOC for investment strategy. Home has equity. Borrow say $80K via HELOC. Use $60K as down payment on rental or for an ADU, rehab, etc. Use remaining $20K as reserves or closing repair costs. Rental income covers HELOC payment. Property appreciates. You refinance or pay off HELOC. Repeat. This is how many investors scale without liquidating stocks or waiting years. Detailed repayment example. Borrow $100,000 via HELOC. Draw period, 10 years. Interest-only payment roughly, $100K x interest rate. After 10 years, draw ends, now repayment begins for 15 years, or 20. Payment becomes principal plus interest. If interest rate has increased, payment can surge. Exit strategy. Either pay it off, refinance into a new HELOC or first mortgage, or sell the property. What is a HEI? A home equity investment is not a loan. You don't pay interest, you don't make monthly payments in most cases. Instead, you agree to share a percentage of your home's future appreciation with the investor. Company gives you cash today, e.g. $120K. You keep your home. When you sell or refinance, you pay the company its share of the appreciation, for example, 15 to 20% of the gain. You may have a buyout option if you want to keep the home and pay them earlier. You earn income but want to avoid monthly payments. You don't qualify for a traditional loan due to income or credit. You care about legacy plan. You know exactly what the cost is. You want to use equity for something, college, debt payoff, business startup, but you don't want to increase your debt burden. Let's talk HomeSafe, retiree freedom and legacy planning. What is HomeSafe? HomeSafe is essentially a form of reverse loan for homeowners, especially age 62 plus, who have significant equity in their home. It allows you to access equity without making monthly mortgage payments. No mandatory monthly mortgage payment in many structures. Stay in the home as long as you live in it and meet obligations, taxes, insurance, maintenance. You retain title. Heirs can keep or sell the home. The loan is repaid typically when home is sold. Excellent for retirees who want to eliminate payments and live comfortably. You gain monthly cash flow or lump sum to fund retirement. You still leave the home or equity to your children. It allows you to monetize equity rather than cash it out in a conventional refinance. Harmony and Chris, HELOC for investment. Harmony and Chris own a home with $215,000 equity. They want growth. They want to buy a rental. They set up a $95,000 HELOC. $70,000 goes to the down payment on a rental property. $8,000 allocated for rehab and repairs. $17,000 set aside for reserve fund and closing costs. Rental income equals $2,480 per month. HELOC interest-only payment is approximately $530 per month, depending on the rate. They now own a cash-flowing asset, leveraging their primary home equity. Exit strategy. After 5 to 7 years, they refinance, pay off the HELOC, or sell the rental and reuse profits. Donna and Ron, HomeSafe for retirement freedom. Donna and Ron have roughly $780,000 in equity in their nearly paid-off home. Their mortgage payment is still about $2,100 per month, while income dropped in retirement. They elect HomeSafe and eliminate the $2,100 monthly mortgage payment. They're now payment-free, freeing money for travel, medical care, and quality of life. Their children still inherit the home or equity. Heirs handle repayment or sale later. HomeSafe becomes both a legacy tool and a retirement income vehicle. Nikki and Steve, HEI to protect inheritance and avoid debt. They need $120,000 to clear old debts and help their daughter with college. They don't want another monthly payment and don't want to increase debt. They choose a home equity investment and receive $120,000 up front. They agree. They'll owe a percentage of future appreciation when they sell or refinance. There are no monthly payments under this HEI structure. Their daughter now knows exactly what the inheritance will look like. One less surprise. They retain the house, keep flexibility, and avoid taking on more debt. With Compliance Bug, your goal best tool. Why build wealth, grow assets, rentals, ADUs, HELOC, flexible borrowing, lower cost, leverage for growth, eliminate monthly mortgage payment, plus retire comfortably, HomeSafe freedom from payments, monetize equity, still own home. Access cash now, no new debt, preserve inheritance clarity, HEI, no monthly payments, defined cost, equity access. Need flexibility, future options, possible exit by refinancing, selling, HELOC clear draw, repayment periods. Known exit dynamics, legacy, inheritance clarity, and low payment stress, HEI or HomeSafe. Either avoids conventional debt, HomeSafe also gives payment freedom. Exit strategies to always plan for HELOC. Anticipate draw period end, repayment shock, plan refinancing, payoff, or sale. For HEI, know the time frame, shared appreciation cost, buyout options. For HomeSafe, heirs must plan to refinance, sell when the homeowner passes. No implications on estate. It's not enough to know the tools. You must understand the market you're operating in. Here are real forecasts from reputable firms. J.P. Morgan Research expects U.S. house prices to rise by about 3% overall in 2025, citing the higher for longer interest rate environment. They also estimate a housing shortage of roughly 2.8 million units, which could take around 10 years to resolve, giving structural support to home equity. Deloitte's research predicts that by 2034, alternative property values may grow at a 15% compound annual growth rate, underscoring opportunities in non-traditional real estate investments. What this means for you: even if home price growth is modest, 3% per year, your equity can still grow meaningfully, especially when you pair it with strategy, HELOC investment, etc. Interest rates likely remain elevated. More premium on strategic use of equity. Supply constraints mean homes with equity will remain powerful assets. If you're watching this and thinking, which of these options is right for me? Don't guess. Click the link below for your free 15-minute consultation. We'll look at your specific equity, your home, your goals, and I'll help you map the most effective path for your situation. If you found this video helpful, please like, subscribe, and share it with a friend who needs to hear this. Next up, how to lower your property taxes in 2026, legally and smartly. You won't want to miss that. Disclaimer: this content is for educational purposes only. It is not a loan offer or investment advice. Each homeowner's situation is unique. Always consult a licensed mortgage professional, a financial advisor, and a tax professional before making decisions. NMLS 1020597